Well, good day, everyone. Welcome to our Trading a Smaller Account webcast. I'm Connie Hill. I'm sitting in for Barbara Armstrong while she is recovering from knee surgery. It was a big deal, and so it's going to take a little bit of recovery time for her, but she's planning to be back mid-month, say in August. All right, and I know you guys will be excited to have her back. I am joined in the chat by Mike Fairborn. I'm glad Mike is there. He's a friend and a fellow coach, and he's been trading in the markets for a long, long time. As you have questions, go ahead and type those in. I'll try to catch your questions if I can, but if I can't, Mike will try to answer your questions there as well, or if it's a little bit off topic, he'll handle that for me. Now, he put out there our handles. We're both on X. I'm Connie Hill CS. He is Mike Fairborn CS, and we'll post educational content, things that you might be interested in the market. A post that I saw of Mike's this morning showed a lot of the stocks that were having earnings this week, and man, we have a boatload of stocks. I was going to say influential stocks that are announcing earnings this week that I think could shape our direction and what happens. So I'm glad that you've joined us here. Let's go through our disclosures and let's get on with our agenda. Options carry a high level of risk and are not suitable for all investors. We're going to be using the paper money software application here. It's for education and informational purposes only. And what we discuss is for information and educational purposes. Don't consider it a recommendation. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. Now, I do want to give a quick shout out to so many of you here that are so friendly. And here this morning, we've got Andrew, APA, Chris, Marcus, Jackson, Lola, D. Womack, Life in the Fast Lane, Sharon, Janet, David, Regina, Ray, Mighty Mouse, PR514, Andrew, happy to see all of you here today. We're going to take a look at what our markets are doing. You probably know because you probably keep track of the markets. We'll take a quick look at it, see what that might mean. We're going to continue on the vein that we started last Friday. Last Friday, we started talking a little bit about using implied volatility and beta, the beta of a stock, to maybe help us identify what strategy might be best for us as far as creating a trade in our smaller account. Okay, we're going to look at a couple of existing trades just very briefly, but we're going to spend more time on some new trades and implementing implied volatility and beta. Now, this class assumes we have a $20,000 paper portfolio. Your size may be different. Yours could be smaller, yours could be bigger. You're going to have to adapt our position sizing to whatever size of account that you might be working with. And one thing that's nice is you can practice in paper money before you even touch your live account. So in this class, we won't have any positions bigger than $5,000. Why is that? It just takes up too big of a chunk of the capital. We need that capital to be working for us. We don't want to risk more than $400 to $500 in any position, and so we stuck to that. And generally, what that means is we're going to be shooting for trading shorter and intermediate time frames. Typically, not anything real long. We're going to trade both bullishly and bearishly. Right now, we've had a lot of bullish opportunities, not so many in the bearish camp. When we do bullish strategies, there's a list of any of the strategies that we might consider doing. Long stocks, long calls, short puts, buy right covered calls, short put verticals, long call verticals. You're going to notice we do a lot of verticals in this class. The reason for that is that it gives us so much flexibility. If a stock's expensive and you couldn't buy an option price for it outright because of your account size, man, putting it in a vertical sure makes it a lot more feasible. Now, when we're bearish in the markets, we'll do some long puts, some long put verticals, some short call verticals. Sometimes we'll do some iron condors in this class or calendars, depending on what we're seeing in the market and stocks, and if it looks like maybe that might be a good fit for each of them. So those are our constraints that we work with. All right, let's head over to Thinkorswim. Now, I've got up here an SPX chart. And you guys know every day it's like churns a slightly higher new high, slightly new higher all-time high, right? It just keeps just grinding up there. And what I put on the chart with it here today, the 10 is or the blue is a 10-day moving average, my red is a 30-day moving average. And then we have down here this market forecast. And this market forecast, it's a study. You can put it on your charts. This is kind of a fancy one, and I call it an augmented type of study because some extra things that are going on with it. So it is a script. But essentially, this is it. There are 3 lines that are trying to show us what's going on in different time frames. The red line is super short time frame, like 1 to 2 days. It can go from the upper reversal zone, which is 80 or higher, to the lower reversal zone, which is 20 or lower, in a couple of days, a day or two, it could do it. So super fast moving line for those that maybe are doing very shorter, super short-term trades. The blue line is more a little bit like swing time frame, maybe 3 to 8 days, maybe up to 10 days is what it is trying to forecast for. And so whatever direction those lines are going, we know if it's up, then it's bullish. If it's down, it's bearish. When it is above this 80 line up at the top, in that what we call an upper reversal zone, this that would say the market is strongly bullish. And we can see this green line, which is more of the intermediate line, that's more of the showing us the intermediate trend going on with the SPX. We can see it's been bullish or pretty strong for quite a while now. Look at this. It has been in that upper zone since looks like about May 6th, something in that time frame. Okay, and it has just stayed there. Sometimes we will get something called a cluster, and a cluster means all 3 of these lines are either in the bottom reversal zone or the top reversal zone. One of the charts we're going to take a look at here in a minute has that, but right now the reading on this is 97. So it's letting us know the SPX is strongly bullish. Let's see if the NASDAQ looks similar, because it too has been churning out slightly higher high, slightly higher high. And so we can see here, yeah, its intermediate line is at 94. So well up into this upper reversal zone, letting us know strong bullishness. And the blue line's kind of up here in the top. It looks like maybe it's angled down a little bit. So maybe a little pullback is what we might see over a swing time frame. But the very shorter term trend is showing it going up. That red line is heading up. So we've kind of got bullish, bullish, and then maybe slight pullback. Wow, but that blue line's still in the upper reversal zone. But the angle headed out a little bit might be a tad indicating a pullback. That could happen. We don't know. And then let's look at the Russell 2000, which has been just performing quite well. Getting back, I mean, it hasn't hit its previous highs here, but it has made such a great long run after having a really discouraging part of the first quarter and end of last year, where the Russell 2000 was down. Those stocks are finally hitting. And so what are we seeing on their lines? Upper reversal zone on that intermediate line, it's at 89. So maybe not quite as strong bullishly as the SPX and the NDX, but still bullish, okay? Red line's heading up, blue line's heading up. So all 3 of these time frames that we're looking at are giving some type of bullish indication. Now, I told you one of these had a cluster, and I think I may have skipped over that cluster. Maybe it wasn't as recent as I thought. It wasn't as recent as I thought, but I'll show you here on SPX. This red dot here, and I'll share this script with you in just a moment for those of you that don't have it. This red dot indicates what we call a cluster, and a cluster means all of these lines, the red, blue, and green, are all in the upper, in this case, the upper reversal zone at the same time. They don't have to cross, they don't have to touch. They just all have to be above there. And when we see that, it gives us an idea that maybe there's some extremes going on and maybe we might see a reversal. But look at this, you guys. Look at how many times we've had a cluster on the SPX. I'm going to point them out here too. I'm going to put a little mark on them here. If I can get my tools to cooperate. There we go. Here's a little cluster. Here's a little cluster. Here's a little cluster. Here's a little cluster. So all 4 of those would have indicated that possibly there was going to be a reversal, would look for confirmation of that. And guess what? It hasn't happened yet. That green line is still in that upper reversal zone. So we watch for them, but we don't jump to conclusions right when we see them. We're just kind of like, oh, let's pay attention. Let's see if this line is finally ready to come out. All right. Let me just look real quickly here on my scratch pad. And if I don't see it here, I may have to put it, oh, there it is, our market forecast enhanced. Those of you that are here live, I'm going to chat this script out to you. And really, it gives you the same measurements as the market forecast that you have in your generic. It just gives you some shading with the lines, and it tells you what the exact reading is, what the name of the line is, momentum, short-term or intermediate, and what direction it's going, if it's rising, if it's falling. Okay, so it just gives you a little bit more information that you can quickly identify. Now, remember when we share these scripts with you, they're never guaranteed as to accuracy or timing. All right, let's head over to our portfolio. I put a little nudge out in my X account, and I said, what happened to our Nike trade that we did last Monday in this class? I don't know if any of you did a paper trade on it, but I think that's a great way as you're learning these strategies to be able to have some examples, to be able to follow up with them. Because if you put them in your paper money account, then you might have some questions as you're evaluating it. Now, I'm going to go ahead. You can use this study with stocks as well as indexes, but I'm going to pull it off because I really don't want to focus on it with the stocks. I only wanted to look at that with the indices. All right. Well, our Nike trade, let's zoom in here. We got in here last Monday on the 21st. We were seeing the bounce off the 10-period moving average. Stock rallied, pulled back a little bit, and then pop today. Man, it shot up there. We wanted it. It was a long call vertical. We wanted it to get past that 77.50 area, and it did, and it ran up high enough to go ahead and hit our profit target. Sweet. If it hits it earlier than you expect it to, do you feel bad about that? I don't feel bad about that. I've never heard anybody say, I feel bad when it hit my target early. I don't think I've ever heard that in any case. And so as we look at our, let's go to the account statement on Nike here. And what we had here, we paid a net debit of 91 cents. It was a $2.50 wide spread. We were aiming to get on this one. We were looking to maybe get filled at $1.84. If it got to $1.84, we'd say that's a chunk of what we're going to be happy with that and get out of the trade. And so when it gapped up today and hit that order, because he had executed pretty close after the market opened here this morning, it filled us a little bit better, $1.90, so 6 cents higher. Dollar-wise, what did that mean? Well, we had $99 gain on each of the contracts. Okay, what we sold it for, 191 minus our 91 costs, told us, okay, yeah, that's a 99 cent or $99 profit per contract. We had 5 contracts out there, so that gave us a gain of about $4.95 on that one trade. Now, can something like that boost a smaller account, right? Getting just kind of a nice, I'm going to say, stable trade. It wasn't necessarily the bases loaded, but it did pretty good for us, right? So yeah, absolutely, that can definitely help out. Going back to the market forecast here, Treasy says, it looks like the values are in the upper range. They are, and so what you have to recognize is that's not a bad thing. It just means buyers are in control. Look how long they've been in control. Okay, so I don't want you to be worried about it per se. Okay, another stock I want to talk about that's a trade we have ongoing here is a strategy that, we won't use a ton of, but I do want to discuss it. Is this HSAI? We sold a 90 put that expires August 15th. So it still has about 18 days. Initially, we brought in a credit of $1.35, so we know that's going to be our max gain with it. It's $135, and we only did one contract here. And it has kind of started to work in our favor. We're seeing the value of that contract go down. It's at 75 cents right now. Awesome. We love to see that value shrink because that means we're getting closer to being able to maybe lock in those gains. Now, management wise, that's what I wanted to talk about with this trade, because what should we do with it? Well, we might not have to really do a whole lot with it. Remember, when we sell a put, we don't mind taking ownership of the stock. If we did take ownership of it, it would be at $20. Plus, we received $1.35 of credit right from the get-go. So what some people might do is they say, well, $20 minus that $1.35, my net debit now is $18.35. Oh, yeah, that's nice for us, isn't it? Let's go look at this stock here, just what the chart looks like. And I'm going to zoom in. So this is where we got in on last Friday. Not Friday, I should say 2 Fridays ago, on the 18th. Okay, we got in here. It looked like it was maybe bouncing off the 30-day moving average or this diagonal support area. And it's continued to go up nicely. And that's what we want. Got a little line here showing our $20 strike price that we would like it to go above it. So it's working for us. We're just going to sit there and let time decay. A little bit more time, a little bit more time. If it makes a move here this week, maybe gets a little bit closer to this horizontal resistance where it's making an ascending triangle formation. If it makes a run up in that direction, we might look to get out of it early and just close it down and take the profit, but we're going to let it work. Okay, any questions on either of these trades that we just took a look at? Yeah, Paul says, these base hits add up. They do. These base hits, or I'm going to say significant gains, yeah, they really help to build that smaller account. Well, let's come over here. Let's take a look at a chart for our first new trade that we're going to take a look at here today. Coherent Corp. And you can see on here, it kind of has what we might consider, some might consider this kind of a cup and handle formation where it had, oh boy, that's a big fat line here. All right, I've got my fattest marker here. And maybe kind of having a little bit of a basing pattern down here. And then just kind of turning the corner, making higher highs, higher lows, higher highs, higher lows. And what is it doing today? Well, it looks like it broke through some resistance here. I go ahead and, oops, let me get rid of that and zoom in here. Looks like, maybe there was some short-term resistance there, about 100 or so. And what did it do? It's popped up above it. Some traders don't mind getting into a trade on a breakout. Now, we've got to keep earnings in mind. Okay, so every single one of these stocks has earnings coming up, but they're a little ways out, to the point that maybe the trade could completely be finished by the time we get to earnings. So this has an estimated earnings date here of about August 14th. Well, we're sitting here July 28th. Could our stock move and hit our target before we actually are worried about earnings? Yeah, it absolutely could. So we're going to notice we have earnings. We're going to take note of the date, and we're going to say we don't want to be trading over earnings, but our expectation is to be out of this already by the time earnings comes up. Now let's look at the implied volatility on the trade tab for this. And let me kind of collapse these. And let's look at the beta. Okay. Remember we talked about beta and how beta gives you an idea of the movement the stock has been making, and actually the calculation of beta is over 5 years. So when you've got some newer stocks, they won't have that calculation. I'll show you where you can get an alternative calculation for the beta. But remember, a beta of 1 means about what the average stock on the S&P 500 moves. So if the SPX moves $1, what can we expect in movement, either up or down, of this stock is $1.84. So is that significantly more than 1? Yeah, the answer is yes. Yeah, it's not quite 2 times what the SPX does. That lets us know we've got a little bit of volatility in it. When we see something like that, we shouldn't be surprised that these implied volatility priced into the options, we shouldn't be surprised that they're not in the 20s and the teens. Okay. We would expect them to be a little bit higher. And I would say, yeah, these are in a high range. They're not extreme. We've seen some way more extreme than this. But in this kind of a scenario, we already have a little bit of high implied volatility. So some of you might be thinking, hey, maybe selling strategy. The other thing I want us to consider here is, what does a stock do many times as it's getting ready to go into earnings? What happens with implied volatility? Does it go up? Does it go down? You can either answer in the chat or to your dog or your computer screen. Yeah. Prior to earnings, I don't have that study on, but usually implied volatility ramps up a little bit. Now, would that help a short vertical or would it help a long vertical? Which of those would it help more? Well, because implied volatility will impact, well, it would impact a short vertical and a long vertical, but it might benefit more a long vertical because we've got a long call on it. If we decide to do a short vertical on it, really we would want implied volatility to drop, and where some of them have these earnings dates out here might not be advantageous. Okay, so I want you to consider that. All right, you guys, excellent. Up, up, up. Yeah, that's what volatility does as we're getting into earnings, because there's an expected move, and we can go back and see what the stocks have moved over earnings and get an idea. Is it a big mover? Is it a small mover? But yeah, we expect that volatility to ramp up a little bit. So in this case, what should we do? Should we do a short vertical or a long vertical? Because the stock is a $100 stock, so more likely than not, might not have options priced in a way that we could do just a single option in our account, right? So let's come out here. Looking at this, let's see if these numbers still work. You can see there's some of the contracts have a great deal of open interest, and some of these don't, right? 4, 6, 0, 39. So we have to be careful and try to select contracts that have some open interest here. We're going to see if this one still makes sense. I think it will. Time-wise, 18 days. We're looking at the August 15th. The earnings should be over by then. Okay. Generally, a trader might look for a 20 to 40 day time frame. Sometimes they have to go out to 50 days on a time frame of what they want to sell. This is actually below that, right? It drops below the 20 threshold. It's right there about 18 days. And sometimes we can find some trades that might work out just fine. And so let's see how this looks. We're going to do 100 and 105. So we're going to say buy vertical here. And you can see out here, we've got 2,000 contracts at that 105. So we're just going to change this strike price here and see what it looks like. Okay, I'm going to go ahead and I'm going to lock this in at 250. So basically this would say we would be risking $2.50 to make what? 5 minus 250 for 250. Okay, risk 250 to make 250, which is, if we did the math on that, that would be kind of looking for 100% return, which is fairly healthy. How do the probabilities look here on this? We need to, we're selling the 105 here. So as we come out here to the probability of the 105, right now it's sitting at 56%. Now, many times we would like to see that maybe a little bit higher. When we're trading probabilities, sometimes we like to see that 60 or higher, and it's not quite there on this trade. Now, if your rules are very strict, that you say, no, it must be 60% or higher, then this might not qualify for your rules. For what we're working with here, I think we're going to be just fine. Okay, we're going to go ahead, we're going to place the trade, but I want you to be aware that it's maybe, let's make sure I've got the right probability here. Oh, it is OTM, out of the money. I usually have my OTM in this column. Okay, so we just want to be aware of that. How many contracts could we do here? If we can risk $400 to $500 in our account, how many contracts could we do? We can do 2. Okay, so we're going to do 2. Let's up our quantity here, and we're going to put in a target to get out, a profit target. that if the stock makes a move like we're expecting it to, we're going to say, if you make a chunk of that move, you make a big run, and we get a lot of meat off the bone, we're going to take it, get out of the trade, just like we did on the Nike trade. We weren't holding out to get every little penny out of it. So we'll do first trigger sequential. We're going to go ahead here and say not analyze, create opposite order. And what would you say is a chunk of 250 that we have to gain? Would your chunk might be, some people's chunk is 50% in the first week. They're like, if I get 50% of that in the first week, hallelujah, I'm going to take it and be out. And some might, put in an order for that. And there might be other people that want to maybe start with a little bit more of a chunk of that. So something we use frequently in this class is 70%. That if we can get 70% of this value, we'll go buy the contract out. Well, when we can get 100% or 70% of 250, that'll give us a value. I'm going to multiply this by 1.7. Okay, because that will include the 250 plus the 70% of the 250 that we're looking for. Just turns out I don't have to type in new numbers on this one. Okay, so 4 1/4 is where we will get out. We're not going to try to get everything out of it. We're looking, if it makes the move that we're looking for, we're going to be happy campers to get out with a decent size base hit, or maybe it's going to be a 2-hit run, right? We'll see possibly what might occur with it. Nothing is ever guaranteed, right? Let's go ahead. Let's put this in our bucket of creating a smaller account. We're going to keep our eye on it. We're going to want to get out by earnings, because typically that's what we do in this class. There will be sometimes we will do a trade very specifically for earnings, but most of the time, many people are trying to avoid that. Okay. Now, as I look in the chat here, let's see what Two Continents says. Are you not concerned about the difference between the bid and the ask spread? Let's answer that question here. I'm not. All right. If I look here, say at 780 by 820, that's 40 cents, right? Some of you might go, oh, 40 cents is kind of high. But if I take 40 cents and I divide it by the ask price, which is going to be 8.2, it's going to give us a percentage. The percentage of the spread is really what we're most concerned about. And it's saying it's going to be about 4.8%. Okay, so many traders, if it's 5% or lower, for them, it's a yep, I'm just going to go on it. Some people might still feel comfortable with it if it's 7 or 8%. Many traders will draw the line at 10%. If we did that calculation and it took up more than 10% of the spread, we wouldn't be happy with that. We would not take the trade. Okay, I'm glad you asked that question. Appreciate you doing that. Yeah, Paul did his math real quick too. He said about 5%. Yeah, just about 5%. Now I'm noticing in the chat there is a survey, and you guys know we do this from time to time. We'll put a survey out, just kind of ask for your feedback. And so I'm just going to encourage you to do that, because we really appreciate it when you take the time to fill it out for us. And I like easy surveys. I'm not a fan of a big survey. Okay, so an easy survey, 2 radio buttons to click, pop, pop, and you can be done. Okay, on a scale of 1 to 10, answer the question. Now there's 2 questions that you can answer if you'd like to. And I also say, if you want to communicate some information to me or some information for me to pass on to Barb when she gets back here and she has her multi-million-dollar knee, then I'm happy to share that information with her as well. And you can use that space to do that. Okay, so Mike's got it posted in there. He'll post it again before our class is over, just as a reminder. And if you want, you can just click on the survey right now, let it sit in the background. Don't worry about it until it's time for you to go or our class wraps up. Okay. All right. MB says, what about the delta, 63 delta versus the typical 30 delta? MB, on a credit spread, we might be targeting a 30 delta. In a long vertical, what we're looking to do is kind of spread it out. So we're actually going to buy this option here, the 100 strike price. And we're not trying to target necessarily a particular delta on the one that we sell on that leg. Okay. Many times, sometimes it'll be a 50 something, a 40 something. Sometimes this value here will be a 50 something or 60 something, sometimes even a 40 something. Okay. And so it's really on the credit spreads where we really focus on that 30 delta. Okay. So in this trade, long call vertical, we're not as concerned about it. Okay. We're willing to risk $1 to make $1 in this trade. Okay. Let's look at our next one here. On semiconductor, ON. Have the semiconductors come to life? Yeah, they really have. What's happened here on this stock? It's had a nice run up. It's sometimes bouncing nicely at that 10-period moving average. Most recently, it pulled back to its 30-period moving average. Yes, or Friday, it got a hold, and it's continuing on that path a little bit here today. Now, it does have earnings coming out. Earnings is on the 4th. The 4th is going to be, let me look at my calendar, 1, 2, 3, 4. That's going to be a week from Tuesday. So a week from tomorrow is when its earnings is. Let's see if it's in the morning or at night. Before the market opens. That means we'd want to be out of this trade on Monday. Okay, so that we do not hold over earnings. Now, our expectation is maybe we get a quick little pop. Maybe it runs up to our profit target and we take our money and get out. But we'll also look at it on next Monday, make sure that we're out of it. Okay. Rule that we're going to go with is if it's a week or more, then I should say a week or less, then we're going to go, no, we're going to skip over it. Okay. If it's more than that, though, we have a little bit of time that the trade could work out successfully for us before they actually announce earnings, then we're going to continue with the trade. Your time frame might be different. Okay, you might not feel comfortable at a week. Your comfort range might be 2 weeks or 3 weeks. And it may depend on the strategy as well, what strategy that you go with here. Okay, now let's go take a look at implied volatility. Let's look at the beta. I told you I'd show you a different calculation on the beta. I didn't do that. Oh, Mimi loves to trade says August 4 is Monday, not Tuesday. Am I off? 1, 2, 3. I am off. Mimi, thank you. We took that trade in my mind when I counted it out earlier. I was thinking it was going to be on Tuesday. So on our Friday class, we'll have to make sure we're out. We won't look at it again on our next Monday class. On Friday, we'll make sure we're out of it. Mimi, thank you for correcting me on that. Okay. The beta here, 1.46. So if the S&P moves a point, this stock we're expecting to move about more than a point, 1.46. So almost 1.5 times what the S&P does. So that creates a little bit more volatility, and we can see, yeah, higher volatility is definitely priced into these options. Now, sometimes we'll have a stock that hasn't been trading for a long period of time, and so the beta comes up here and it'll say NA. That's not the case with this stock, but let me show you what you can do if that is the case if you run across that. Click on that little lightning, and it brings up this little box here. I wish it would go to the menu that says calculations. It just goes to display, but we really want calculations. So just come down here, click on calculation, and can you see right here, right in this area, it says beta calculation method, standard, or fast, and we've got it set to standard. Well, what's standard mean? Standard basically says it's going to look out, it's going to use 5 years worth of pricing data. Okay, so it's not looking at a real short-term window. It's saying how much volatility has this stock had over the last 5 years. Now, if we come into a stock that's newer and it doesn't have 5 years of history, you can come down, you can change it to fast, you can select fast, but just know it's going to make it be fast on every stock you pull up. Okay, so it's going to change that time frame. So that's something that you have to be aware of. Now, in this case, ON doesn't need it, but I told you I would show you that, so I wanted to point that out in case some of you need to use that. We're going to keep this standard. We're going to keep the 5 years instead of going to the fast and having it be the 1 year. Okay, hit our apply settings and get out of it. Now, this is nice. It's traded over 4 million shares today. It's got some weeklies here. How do these weeklies look? Well, if I were to come out here, say to the 30-day window, well, we've got kind of some small numbers. We've got 280 in the call contracts. Put contracts just don't have a whole lot, and that's what I found in most of the weeklies here. So again, we're going to go a little bit shorter time frame. We're going to go August 15th, especially knowing we have to be out by Friday because that's when they announce their earnings. Now let's see if this still makes sense. It may or may not still make sense. What I was looking to do here was do the 56 strike. We're not going to do a ton of contracts on it, and pair it up here with the one that has almost 5,000 open interest here, which is going to be our 60. So we're looking to do a 56.60 here. So $4 wide. Again, we're going to do a buy a vertical. Why? Because as the stock runs up into earnings, implied volatility is likely to ramp up. Now, if we had oodles of open interest out here at this 65.50 or 56.50 or 57, we would consider doing a spread not as wide, okay? But because that is so little, that's why we're spreading it out. And what that means is we're going to expect a little bit more out of the stock. Now, in this case, we're saying go to, well, let's change this here. Let's get it to our 60. So we've got our 56.60, and I'm just going to come and lock this in. Now, on a $5 wide spread, would take $5 minus 218 to find out what our max theoretical gain is. We know our max theoretical loss is 218. But what do we need the stock to do? We need it to go beyond 60, okay? Where's it at right now? Well, it's already at 59 and change. If we go to the chart and I go, okay, let's put my mouse at 60. Where is it? Where's 60? Okay, something in that area. You can see it's not a huge move. It was there last week. Had like 3 or 4 or 5 days hitting that and above last week. Okay, so knowing that it's coming off of a little bit of a bounce here. So we're going to proceed with this trade. Okay. On this, let's clear out our calculator. So we're going to go 5 minus 218, which gives us actually kind of a nice target to look for. We're saying 282 is the max theoretical gain, but we're not going to go for all of it. We're going to go for a chunk of it. Now, in this case, because we need to be out on Friday, and it's a healthy amount, some traders would say, I'll take 50% of that. I'll be happy with 50%. I don't have to get a ton of it. Okay, so that's what we're going to put in our order to buy it back. Now, if we're risking 218 per contract, we can do 2 contracts here, right? We'll still be less than $500 that we would be risking. Let's multiply this. It's a $4 wide spread. Thank you. Oh my goodness. Thank you. Thank you. You're right. It's not 5. It's 4. Do the math again. 4 minus 218. It's not as healthy as what I was thinking, is it? All right. Yeah, it's $1.82. Okay. It's still healthy. All right. Not as healthy as what my $5 calculation was saying. Okay. And this is actually max gain because 218 is our max loss. Okay, that maybe changes a little bit, right? If we were having a real healthy max potential gain, then we might be content with 50%. On this one, let's go with the 70% again, okay? So we'll take our $1.82, multiply that by 1.7, and that'll say, okay, go buy it back at 309. Okay, we'll buy it back at 309, or we'll exit on Friday so that we are out before they announce earnings Monday morning. Okay, so we'll do our first trigger sequential. Let's go ahead here, create an opposite order. And we'll come down here and we're going to say buy it back if it gets to $3.09. Put it in, make it good till canceled. Right, we don't want to set it up every day, make it good till cancel. Let Thinkorswim, if it gets to this price with a limit order, let it execute. David said must be Monday. Yeah, the earnings are on Monday for sure. And you guys, I appreciate you keeping me honest on the math that it was a $4 wipe spread. Man, I can't pull anything on you, can I? You're just sharp, which I appreciate. Yeah, so we're going to shoot for a profit target. So we're going to put that in, and that's what we're hoping to sell it for. 309, confirm and send, go to our trading a smaller account and hit send. Now, a question that frequently comes up is, we have these examples that we'll use in our classes, and where do these examples come from? Well, I'm going to just show you something really quick. If you're a subscriber to our Trader Talks and you've clicked on that blue YouTube logo in the bottom right-hand corner, that allows you to subscribe. But just do it once. If you click on it again, it unsubscribes you. But when you are subscribed to our channel, it makes it really easy for us to find makes it easy for you to find our content, right? You can see, if I actually come over here to home, we can see what's coming up next. James is going to be here with trading with technical indicators. You're not going to want to miss that. But you can also go over to our playlists. And something we did last week in my short verticals class is we created a new watch list, and some of the trades that we look at here today came from that watch list, okay? And so over here, this one, short verticals, this one on top, build an option traders watch list like a pro. These stocks could be used for any kind of a trade because they're super liquid, okay? So if you're looking to say, hey, how can I maybe create a watch list of stocks that I can use, consider watching this, okay? That might be helpful. Paula says, how do you calculate the profit? Let's go back there. Maybe I went through that a little too quick on that, Paula. Our max theoretical gain was going to be 182. And what I did is I took our current net debit. Let's pull this up here again. It might not be exactly what it was then, but it should be fairly close. Let's bring it up here to 60. Actually, it was 218. It was this 218 value. That's our max theoretical loss. And so our max theoretical gain is $1.82. And so I kind of did a shorthand, okay? I'll do it the long way this time. So let's take 1.82 times that by 70%, because if we get 70% of it, we'd be happy campers, okay? That gives us a value of 1.27. And really, you'd take 1.27, add it to 218 to get a value. Okay, I'll do it plus 2.18 gives us a value of 354. I might have had a typo. Did I have a typo in that? I may have had a typo on that because we were going for 70% of the max gain. I'm wondering if I hit a typo in that, and that is probably why you're saying, hey, wait a minute, 370, not, okay. Max theoretical gain here is 127, right? Times 0.7. Okay, got the right number in there, 88. So we add 88 to whatever our net debit is, and that brought it up to $3 and I think 7 cents that it brought it up to. On here, well, 215 to get filled here. I'm sorry, something's not quite right here. That's our filled orders. Our working orders, okay, here we go. Our working orders say, let's go buy it back at 309. Okay, so we want to buy it back when we've achieved that, when it's gone that high. And I just did a quick shorthand. I did times 1.7 instead of multiplying it by 0.7 and then adding it to the net debit. Okay, so I kind of took a shortcut to get to that value. So I apologize. Appreciate that. And now RG says, 70% max gain is different than 70% profit. You're absolutely right. We're looking at getting 70% of whatever the max gain is, not 70% of the net debit. That debits the cost, but we did that calculation, $4 widespread minus 218, okay, to get what our net debit was for that. So COHR, Andy's saying COHR didn't fill yet. We'll tell you what, our time is out. So I'm going to have to deal with that offline. I'll go make sure it gets filled. Okay. And see what we need to change to make sure that it does get filled. Okay. Let's head back here. Right now, we're not in a market that's really too bearish right now. Mainly, the bulls are just kind of grinding it out higher. So we looked at a couple trades that are doing well. One hit their target. One we're going to let work. That short put, we're just going to say, you keep working. And then we put on COHR. We put on. I was going to look at SHOP today as well. May have to post on that out in my X account, what we might have been looking for on that one. Okay. But you go ahead, take a look at the chart. And as you're learning these strategies, do paper trades on it. That's the best way for you to learn, is to do paper trades and see how it happens and see the decisions you need to make. Okay. Now, I will remind you, there was a survey out there. I appreciate you filling the survey out. We really do appreciate the time you take to do that for us. Looks like Mike may have just posted that out there sort of recently. He'll probably post that out there again, or I can copy it over real quick. All right, you guys, appreciate you being here today. Coming up next, James Boyd, technical indicators, training with technical indicators. You don't want to miss that. All right, you guys, have a great rest of your day. I'll see you this afternoon at 2 o'clock in our ETF class. Bye-bye.